Kevin Brierton here, Caliber Home Loans, certified mortgage planning specialist. We're bringing you valuable educational content so you can make a more confident mortgage decision. Enjoy.
What is debt to income ratio and why does it matter? If you're applying for a home loan, you may have heard the term debt to income or DTI. So, what is debt to income ratio and why does it matter so much when you're getting a home loan? In this video, we're going to explain what debt to income ratio is and why lenders care so much about it. Your debt to income ratio is all about your monthly debt payments divided by your gross monthly income. This number is the one way lenders measure your ability to manage your monthly payments to repay the money you borrow. To calculate your debt to income ratio, you add up all your monthly debts and divide them by your gross monthly income. Your gross monthly income is generally the amount of money that you have earned before taxes and other deductions are taken out. For example, if you pay $1,500 a month for your mortgage and another $100 for auto loan and $400 for the rest of your debts, your monthly debt payments are $2,000. $1,500 plus $100 plus $400 equals $2,000. If your gross monthly income is $6,000, then your debt to income ratio is 33%. Evidence from studies on mortgage loans suggests that borrowers with a higher debt to income ratio are more likely to run into troubles making their monthly payments. Debt to income ratio is important because it tells the lender how much money you have left over after making your monthly expenses. A good target for a debt to income ratio is below 36%. But you can qualify for a mortgage with a higher debt to income ratio. The requirements will vary depending on lender and mortgage type. Ideally, you want to keep your debt to income ratio as low as possible regardless of lender's limits. Paying down debt will help you improve your credit score. A higher credit score and a lower DTI will help you get a better mortgage and better interest rate. Although DTI ratio is important in getting a mortgage, the number doesn't tell the whole story about what you can afford. DTIs don't take into account expenses such as food, health insurance, utilities, gas, and entertainment. They count your income before your taxes, not what you take home each month. You'll want to budget beyond what your debt to income ratio labels as affordable, considering all your expenses compared to your actual take-home income. If your debt to income ratio is high, the higher your debt to income ratio, the more you're likely to struggle qualifying for a mortgage and making the monthly mortgage payments. To lower your DTI, pay off as much current debt as possible before applying for a loan. In most cases, the lender won't include installment loans like cars or student loans that are almost paid off within 10 months. Definitely avoid taking out more debt. For example, don't make any other large purchases on credit cards or buy a new car loan. Wait to apply. If your debt to income ratio is exceptionally high, say around 50% or more, it probably makes sense to pay down and reduce the ratios before you apply for a loan. But sit down with a lender, use a mortgage calculator to help you figure out what's a reasonable monthly mortgage payment. The lower your debt to income ratio, the safer you are to lenders and the better your finances will be. And if you have any questions, please reach out to your mortgage lender. We're here as your mortgage lender as well. We'd love to answer any questions and tell you more about your debt to income ratio, how to calculate it, and how it plays into your overall mortgage and home plan.
Thanks for watching. This is Kevin Brierton, Caliber Home Loans, certified mortgage planning specialist. If you have any questions, don't hesitate to contact us. My contact information is below. I am dedicated to helping homeowners understand the mortgage process and committed to be your no excuse lender. Have an awesome day.